Ever get that feeling?
Yeah.
When you see someone's lifestyle and it just doesn't quite seem to add up to what you think they earn.
The fancy car, the trips.
Exactly. And when you kind of wonder, how are they managing that? Well, it turns out tax authorities sometimes ask a similar question.
Right.
And that brings us to our deep dive today. Discrepancy fiscal. We've gone through some key documents like the income tax law, the LISR, bits of the civil code, fiscal resolutions.
The important stuff.
Yeah, the important stuff. To really unpack this for you, our listener, so you can
Yeah.
understand this, well, often kind of confusing area.
Precisely. And discrepancy of fiscal. It's not about like a small math error on your return.
Okay.
It's more about a significant ongoing difference between what you're spending and the income you've officially told the tax authorities about.
So a gap that makes them think, hang on.
Exactly. It raises that red flag. It suggests the money for that spending might be coming from somewhere. Well, somewhere you haven't declared.
And while the exact amount isn't spelled out, like a specific number.
No, the sources don't give a magic number, but the legal setup implies it's got to be a noticeable, substantial difference to trigger scrutiny.
Okay, that makes sense. So the core idea is spending more than you declare. But what specifically puts you on the radar? What kind of things actually trigger this?
Well, the main trigger is simply that pattern, that clear picture where your expenses, your outflows are consistently higher than your reported income, your inflows.
So it's less about buying one expensive watch, maybe.
Probably less about a single item and more about the whole financial lifestyle picture. You
Right.
know, imagine someone reporting a fairly modest income,
Right.
but they're regularly making huge credit card payments, maybe buying property, taking luxury vacations year after year. It's that sustained imbalance.
Got it. So no official checklist of bad purchases, just the overall mismatch.
That's the essence of it, yeah.
Okay, so the authorities are looking at spending patterns. Now let's flip to the other side. Income. What are your obligations for our listeners when it comes to actually reporting income?
Ugh, okay, this is fundamental. The income tax law, the LISR, is very clear. Individuals must pay tax on their income, all of it.
All of it.
And the definition of income is, well, it's really broad. We saw this in the practicum materials. It's basically anything that increases your wealth.
Anything.
Yeah.
Like cash, obviously, but what else?
Oh, yeah, cash, but also goods you receive as payment, services someone does for you instead of paying you, getting credit, loans, basically any form of benefit that improves your financial position, your patrimony.
Wow. Any other means? Sounds like it covers a lot. Could you give an example maybe? Something you, our listener, might not immediately think of as income.
Sure. Think about bartering. Maybe you're a graphic designer and you design a logo for a plumber and they fix your leaky pipes in return.
Okay, no cash changes hands.
Right. But the value of that plumbing service, that's income to you under the law because it increased your wealth. You got a valuable service without paying cash.
Okay.
Or even say if someone forgives a debt you owe them. That relief from the obligation, that can also count as income. It's about the enrichment.
That really does broaden the perspective on what needs to be declared. Okay, let's swing back to the spending side then. You said individuals don't usually file like detailed expense reports for personal stuff.
Generally, no, not like businesses claiming deductions.
So how do the authorities figure out the spending side of the equation to even see if there is a discrepancy?
It's a good question. While you aren't sending them your grocery bills, the whole concept of discrepancy of fiscal means they do have ways to get insights into your outflows.
Okay.
Our sources don't lay out the exact methods for individuals, like specific software or data points they track day to day, but we can infer things. Financial institutions, for example, have reporting requirements for certain transactions.
Like banks reporting large cash deposits or something, though maybe not specified here exactly for individuals.
Exactly. The specifics for individual thresholds aren't in these documents, but the mechanism exists. And think about big-ticket items, buying a car, getting a mortgage. Those create clear financial records. They leave a trail.
Right, right. So even without itemized reports, major financial moves are visible. What about information from others? You mentioned banks. What about, say, employers or clients?
Yes, third parties play a role. The tax law itself requires anyone making certain types of payments to withhold income tax sometimes.
Like an employer withholding tax from your salary.
Precisely. Or a company paying you for freelance work might withhold. When they do that, they're also reporting that payment and withholding to the tax authorities.
Ah, so it creates this web of information. They see money coming in from the payer's side, too.
Exactly. It provides data points that can potentially be cross-referenced against what you declare as income. It helps build that fuller picture.
Okay, so the potential for a mismatch exists, and authorities have ways, direct or indirect, to see both income and significant spending indicators. What happens if they do spot a major discrepancy for you, our listener? What's the process then?
If they detect what seems like a significant unexplained gap, the first step is usually a review. They'll likely contact you.
Like a letter? An email?
It could be a formal notification asking you to explain the difference. How did you afford this spending based on the income you reported?
And if your explanation doesn't cut it?
Well, if it's insufficient or maybe contradicts the information they have, they could escalate it to a more formal audit, a deeper dive into your finances.
Right, and the consequences. I mean, beyond the stress of an audit.
Well, again, our sources don't list specific penalties just for a discrepancy of fiscal itself, like a unique fine schedule for that term regarding individuals. But the general tax principles apply. If the investigation concludes you underreported income.
Then you owe the tax you should have paid originally.
Yes, plus likely penalties for the underpayment and interest charges for the time the tax wasn't paid. It can add up. We even saw mentions in other contexts, like for businesses, of things like restricting the ability to issue digital tax receipts if compliance issues arise. So consequences for non-compliance are definitely real.
Okay, definitely something you, our listener, want to avoid. Now, are there ever, perfectly legitimate reasons why someone's spending might temporarily spike above their regular income?
Oh, absolutely. That's a really important point. Life happens, right?
Sure.
Maybe you sold a major asset like a second property or some stocks you held for a long time. The cash from that sale could fund higher spending for a bit, even if your salary didn't change.
Okay, that makes sense.
Or you might receive a large gift or perhaps take out a loan for a specific purpose. These can temporarily explain higher outflows.
So the key is transparency, explanation.
Exactly. The key is that these events are legitimate, explainable, and crucially handled correctly for tax purposes. For example, if you sold an asset at a profit, that capital gain generally needs to be reported and taxed appropriately.
Right.
The discrepancy issue really arises when there's that sustained higher spending level with no clear link to your declared income or these kinds of explainable, properly reported financial events. It's the persistent, unexplained gap that causes concern.
That distinction is vital. Persistent and unexplained versus temporary and explainable. What about complexities like, say, having money overseas? Does that factor into this?
It certainly can. While the core idea is often about matching domestic spending to declared income, remember what we saw mentioned. Residents in Mexico generally owe tax on their worldwide income.
Ah, so income earned abroad counts too.
Yes. If you, our listener, have income from foreign sources, maybe investments or work done through a foreign company, and you don't declare it properly in Mexico, but then your spending back home seems high compared to only your declared domestic income, that undeclared foreign income could absolutely become relevant if the authorities start asking questions about a discrepancy. All income sources matter.
Okay, that's a crucial point for anyone with international financial ties. So, pulling this all together, what are the main things you, our listeners, should focus on to steer clear of any discrepancy of fiscal problems?
Number one, without a doubt, is accurate and complete income reporting. Remember that really broad definition of income we talked about?
Everything that increases your wealth.
Pretty much. Be thorough. Secondly, while you might not need meticulous records of every coffee you buy, it's really wise to have a good handle on your overall spending patterns. Be aware of where your money is going, especially significant expenditures, and mentally connect them back to your income sources. Good general financial records are always helpful.
So be honest about income and be mindful of spending, even if you're not formally reporting every expense.
That's a good way to put it. Understand what counts as income, report it fully, and ensure your lifestyle aligns reasonably with that reported income.
Okay, so the big takeaway for you, our listener, seems to be discrepancy of fiscal happens when your spending consistently looks much higher than the income you've told the tax authorities about. It can trigger reviews, audits, and potentially penalties.
That's what the core message, yes.
Making sure your financial life is transparent and your tax declarations accurately reflect your situation is just essential.
Couldn't agree more.
This has been incredibly insightful, really drilling down into what this term means and its implications. It really underscores how important it is to connect the dots between earning and spending. So here's a final thought for you to ponder. As financial transactions become more and more digital and data analysis gets ever more powerful,
Mm,
how do you think the tax authorities' ability to spot these discrepancies might change, maybe even sharpen in the coming years? Something to think about.
that's a fascinating question. The technological landscape is definitely shifting things.
And this deep dive into discrepancy fiscal is exactly the kind of exploration we aim for here, breaking down complex topics for you. If there are other subjects, financial, legal, anything really that you'd like us to tackle, please do let us know. We're always ready for the next deep dive.